Welcome to today's session in the Sciative Knowledge Series. Our distinguished speaker today is Dr. Raj Shivakumar. Raj heads travel strategy, technology, and consulting practice at WNS Global Services, one of the largest business process management companies in the world. Raj has over 23 years experience in the travel and aviation industry with leadership roles in revenue management, pricing, network planning, global sales, information technology, strategic sourcing, and research and development. Prior to joining WNS, Raj was the Chief Commercial Officer at Jet Airways, the largest and the leading airline in India. In this role, Raj oversaw a five-fold expansion in Jet Airways network and was instrumental in the implementation of several revenue management and pricing strategies. Before Jet, Raj spent 15 years at United Airlines in Chicago. Raj has a master's and PhD in operations research and lives with his wife and son in Mumbai. Raj, it's indeed a pleasure for us to have you with us today and share your experiences. Thank you so much.
Thanks, Anshu, and thanks to the Sciative team. Um,
Yes, we can hear you. And for the audience, you can follow live comments and post yours on Twitter using hashtag Sciative Knowledge and hashtag Ask Raj. Towards the end, as time permits, we will take questions posted by the audience. Please make sure to include hashtag Sciative Knowledge and hashtag Ask Raj. Now, today Raj will be speaking on airline pricing, still primitive and otherwise optimized industry. Now, airline industry has been an early adopter of pricing and revenue management science, and a lot of pioneering work has happened in this industry over the last 4 decades. There is so much that other industries can learn about pricing from the airline industry. Raj, we appreciate you have chosen to speak on this very important subject, and we all hope that we can take tips on pricing best practices from your experiences today. Over to you.
Thank you, Anshu, and thanks to the Sciative team. Good evening, good afternoon, everybody. It's indeed a pleasure for me to be here and participate in this conversation. What I'm going to be talking about, like Anshu mentioned, is despite the numerous optimization both in there. Why is it that when it comes to pricing, the extent of optimization has lagged behind? Some of the issues surrounding that, more in the context of what is it that the other industries could learn from, from the airline space, if they were to adapt, similar techniques, in their respective ecosystems. And the way I'm going to be talking about this is to give you a fair amount of background because it's important that you get grounded in the airline principles, you get grounded in the airline revenue management principles, talking about pricing. So there's going to be a fair amount of background that I'm going to give for those of you that may not be free and familiar with how revenue management is conducted. And if you are from the industry, you may find this just for that. Worldwide, the industry generates almost $50 billion in revenue. Being an infrastructure industry and a key driver of economy, airlines have never returned value to the shareholders over any long period of time. Interestingly, other members of the airline value, such as distribution companies, catering companies, all have a margin at the expense of the airlines themselves. Having said that, revenue management was first introduced by American Airlines in the early 1980s. American, by the way, is credited for more innovations than most other carriers. Introduction of the frequent flyer program, introduction of the reservation system, which later morphed into a global distribution system, etc. And like I said, there have been incredible amount of innovations, large and small, in the airline enterprise that have happened over the last 4 to 5 decades or so, and particularly in the world of revenue management that got introduced in the early 1990s. pretty much every this has become revenues, so advanced systems, whether these are full service carriers, whether these are LCCs, revenue management is practiced worldwide. And based on a lot of the empirical work that has been done, and based on what I have seen happen in a couple of airlines that I have participated in, management be credited with boosting the worldwide airline revenues between 30 and 40 billion dollars annual on this base of 750 billion dollars that I talked about. Having said all this, let me spend a few minutes introducing the art or science of revenue management. Revenue management, like I said, is a science or art of maximizing the revenue of every single flight in an airline's network. It works on a flight by flight basis. The airline's revenue management department, they're responsible for individually maximizing the revenue on every single flight. And like every other industry, revenue management in the airline space rides on two key principles: resources, in this case, airline seats. A certain point, an airline seat is like a perishable commodity. An empty airline seat has no value. Secondly, customers that are willing to pay different prices in exchange, or as an example, price conscious customers that may not be as schedule conscious, or schedule conscious customers that may be willing to pay a higher price in exchange for the flight, that they may choose for traveling. So these two principles become the underpinning, for revenue management in the airline industry, and it is no different from most other industries. And having said that, revenue management has two sister areas. One is yield management, and the other one is pricing. Yield management is also called inventory management or seat inventory management, on which airline that you talk to. And of course, pricing is called pricing. Management, just to give you a brief background on how that is conducted in the airline space, and it is important because it's closely correlated with some of the challenges and the opportunities space as well. Yield management uses sophisticated operations research and statistical principles to simultaneously achieve two sets of objectives. It is crucial to have the optimal overbooking profile on every single flight. What does that mean? Given that travelers have the ability to cancel or no-show on a certain flight, and given the fact that perishable commodity, airlines typically tend to overbook based on a certain risk profile and the need to capture that additional revenue. The second piece, which is probably more widely considered as part of revenue management, allocation of seats between the various price segments. Before that, it rides on the principle that customers can be segmented, and different segments of customers are willing to. So revenue management, having overbooked having identified the optimal overbooking profile rather, the the next or the primary job is to ensure that the right number of seats are allocated price segments. Usually, there are about 10 to 15 price segments that are set aside, to the economy cabin, up to 5 price segments that are set aside in the business class cabin, and 2 to 3 price segments that are set aside in the first class cabin. As to how many you should have, between the various cabins, it strictly depends on the capacity that you want to, that you want to have, and how the segments that you see. And really, the only limitation, and this is because of the way the global distribution systems work, is the number of classes in total cannot be more than 26. Represent the classes is by the letter of the English alphabet. Secondly, what the yield management systems also do, and this should be remembered in the context of what we're talking about, is as they optimize the passengers, they do not look at the real fares, that are out there selling in the market. They look at an abstraction of the fares, expected average, if you may, of the fares that are selling in the market. So, there could be multiple fares, selling in a certain booking class. Part of what the revenue management system does, or part of what the preparatory work for the revenue management system is to capture, these selling fares and come up with an expected value, if I may, for that booking class. Management systems abstract the price segment into each of these booking classes. So, like I said, there are 10 to 15 price segments, or booking classes that are set aside, in the economy cabin. And each of these booking classes are called RBDs. This is the airline parlance. It stands for Reservations Booking Designator. And the revenue management or the yield management system itself works on the principle of expected marginal seat revenue, the AMSR. Principle was introduced by a professor from MIT, Dr. Peter Bellababa, and he's widely considered the father of airline yield management by a lot of folks. And essentially, the way expected marginal seat revenue works is, for every single potential passenger, the value of moving the passenger down to a lower booking class with a higher probability of versus keeping that passenger and the associated revenue in the higher booking class, however, with a lower probability of realization. So as you iterate, as you decide, based on historical traffic and based on the anticipated demand that is going to materialize in each of these booking classes, the system constantly trades out the probability of the bird in hand versus the two in the bush principle. And the revenue management system itself, or the yield management system itself, runs. It could be daily for very large airlines based on the computing horsepower that they have, or a few times a week. What it does is, once it identifies the optimal allocation on each of the flights based on the booking classes that I talked about, it records the seats available in each of these booking classes in the airline's reservation system. This reservation system itself is connected to the global distribution systems. You may have heard of names such as Sabre, Amadeus, Galileo, etc. All of these systems, they serve the travel agents, and the travel agents log on to the global distribution systems, one or more of them. The global distribution system in turn connects to the airline's reservation system of what may be available, and it maps it to the current selling fare and displays it as an available seat to an end customer. So if you were to go to, say, use ClearTrip or a Make My Trip or go to a travel agent and ask for a certain flight, and you see the fare today, 100 rupees, and 3 days later, if you come back, the same flight shows a fare of 4,400 rupees. It's quite simply because of the fact that, because of the demand that has materialized, or simply because of the system running once or twice more, that it is better off not having any availability in the 3,300 bucket, availability only in the 4,500 bucket, based on its forecasting algorithms that have identified. So that I want to go back to the price segments against which the inventory is optimized. And like I said, the inventory is optimized based on an abstraction of the fares, okay? Because the yield management system can only work on one price value. It cannot work on multiple price values. Okay. However, there are multiple price values, that are out there in the market, and I'll get to that in a second. There have been two major advances when it comes to yield management over the last, couple of decades, ever since it got introduced. So yield management focused on what is now called a leg or a segment-based methodology. So for a passenger, for example, just to give you an example, if you are a passenger traveling on a Bangalore, Mumbai, London, itinerary. That for this is separate for a Bangalore Mumbai flight and separate for a Mumbai London flight. Clearly, while this was a good first step, better than nothing, it does not consider the connecting aspect of the customer, trading off selling passengers, meaning Bangalore, Bombay, and Bombay, London, versus a connecting passenger. And hence, clearly, while it may serve the purpose of several carriers that may not have a huge amount of connecting traffic, purpose of carriers that are quote unquote network carriers. So in the early 90s, in research was made, in the field of airline yield management, where path-based or origin destination-based yield management systems started coming into vogue. We built one at United. Several large carriers have one now. So here, every true itinerary is valued separately. Sorry, a Bangalore, Mumbai, London passenger, you know, carries his own forecast and own what we call a bid price. So if a bid price is above a certain threshold, this passenger is accepted by the yield management system. And if the bid price falls below a certain threshold, the passenger is rejected. Empirically, it what has been shown is can use by approximately 5 to 6% over and above not having any system at all. And a path-based or an OND-based yield management system can further increase the revenues by 2 to 3%. I've talked a lot about yield management, and the reason I wanted to give you this background is because it is very important to understand the connectivity between airline yield management and airline pricing. Why some of this research in pricing has not really translated to an independent field of revenue production for the airlines. Moving on to pricing, airline pricing is just incredibly complex undertaking. The price that the end customer sees for an airline comprises fares. It comprises numerous fare components such as surcharges and fees and fare rules. About advanced purchase requirements, Saturday night stay requirements, etc. The airline prices or fares is managed through an arcane legacy computer systems by specialists. Religiously benchmark fares and fare rules against their primary competition basis. Just as an example, Etihad and Emirates are global carriers, and they have a lot of similar routes, identical fares in a lot of their overlapping routes, and they follow each other, very very diligently. While there, like I said, while there have been significant advances in yield management, the same cannot be said for pricing. And why is that? There are a few reasons, at least in my mind. The first one is there are too many passenger segments, you know, and a key requirement to evaluate the efficacy of moving up or moving down from a pricing standpoint, a certain action, and be able to pinpoint that the result is because of that action, roughly speaking. However, with way too many passenger segments and way too many fare points, even within the example versus connecting passengers that the airlines have to trade off. There are leisure passengers versus business passengers. There are online passengers versus interline and code share passengers. And of course, there is group traffic versus individual traffic. Many passenger segments that all hit the same flight. And secondly, there are just way too many price points that are too close to each other. Okay, just to give you an idea, on a domestic flight, for example, Mumbai to Chennai flight, the price points could just be 200 or 300 rupees apart on a base of 2000 or 3000 rupees. And when the price points are this close, possible to be able to say that a certain a certain number of passengers were carried solely because the fare was moved up or moved down. Thirdly, there has been a rampant commoditization, leading to inability to communicate the reason for price differential to the consumers. I think it's an important point. While airlines have made product advances, whether it's in some IFE, in-flight entertainment, or a number of streaming, whatever the case may be, there isn't a coordinated linkage between product innovations and value, and that is even if it is a higher price, that is generated rather. And thirdly, or fourthly rather, price changes are often coupled with incentives to the intermediaries. When the airline goes on a sale to generate more traffic, they also hand over an additional point or two to the travel agencies to push more seats. Airlines are able to determine the traffic that got realized, if any, is because of the fare drop, or is it because the market is incented to sell more of those seats because of the additional incentive. Next one, there's an incredible amount of dynamism, in the industry. There's an incredible amount of chaos in the industry. So it's impossible, given the fact that the airline industry is incredibly dynamic and fiercely competitive, it is impossible to hold on to any pricing strategy for any extended period of time. And it is crucial for us to be able to value or for us to be able to evaluate pricing strategy was solely or mostly responsible for a certain outcome. Let me give you an example. If you were to kind of peel the onion and look at any pricing tactic or any pricing strategy, the strategy involves increasing the price or reducing the price. If you were to increase the price, that airline is a cash-starved industry, management has very little appetite to take risk on an increased price, risk for conducting this as an experiment. So more often than not, a pricing strategy that reflects an increase doesn't stay for too long, doesn't match. On the other end of the spectrum, any pricing reduction, it's just a matter, it doesn't stand for too long, sometimes hours, matches you. So either end of the spectrum, a price increase or a price reduction has no chance of being in the market, for any sustained period in time. And lastly, there's just way too much noise in the system. There are just too many factors that affect, the traffic that goes on. There's clearly industry activity. There are external effects. There are group and individual movements. All of this put together makes it impossible for airlines to decide whether a certain pricing action, especially if it is a certain pricing action that is sort of initiated by them, regardless of what the industry does or does not do, is there on a sustained basis. All meant is most of the focus on the airline side yield management systems, and pricing has been relegated to, for the most part, I'm not going to say 100%, but for the most part, identifying who your competition is on a route by route basis, and essentially matching or taking a few hundred rupees or a few $100s, above or below them. And so hopefully, all this sounds like a lot of negative here, but hopefully this can be turned around. If you were looking at other industries, on what does it take, for an effective pricing strategy to be measured, or the efficacy of an effective pricing strategy to be measured. A lot on data mining, data warehouses. There have been the pioneer in setting up data warehouses, the behavior of the booking profile, based on certain pricing actions. However, their ability to optimize prices, if I may, okay, has just not been there, I mentioned above. And hopefully, this can be turned around, like I said, to help you determine what circumstances have to prevail and what actions have to be initiated and what the underlying criteria has to be for truly measuring the impact of a certain price and its effect on your product and in the marketplace in general. So that's pretty much what I wanted to say. And if there are any questions, I'm happy to answer.
Raj, thank you so much for sharing your thoughts. I think you've covered a lot. You went through the basics of revenue management and pricing, the way revenue management process works, system works, breaking down the entire decision process into fair slabs and then allocation of inventory to those fair slabs, and how the role of pricing comes into picture here due to the numerous non-quantifiable or non-easily quantifiable factors. I think your depth of coverage was really appropriate for that session today. Now, I would like to ask you a couple of questions. The first is, you mentioned that revenue management adds about 5 to 6% in the revenues of the airlines, and in case the airline both adopts the origin destination based revenue management system, it adds another 2 to 3% to the revenues. Now, I remember there was a bunch of research done in the airline pricing and revenue management space that looked at customer choice behavior in conjunction with revenue management, and modeling both the pricing and revenue management piece as one single system. Any thoughts on why those types of systems did not come up as the next phase of evolution in the airline revenue management and pricing space?
Yeah, it's a good point, Anshu. I think a lot of it has got to do with the reasons that I just gave. Okay. While it's an incredibly rich area, and yes, if you were to think about it, clearly you would want to jointly optimize and the associated number of seats that you want to set aside, for each of the fares, if I may. But given the number of segments that we are dealing with, and given all of the dynamism and the chaos that is existing in the marketplace, while there may be research techniques that allow us, in this day and age with the advanced computing that we have, while there may be while there may be computational capability to be able to jointly price and yield manage at the same time, in reality, this joint optimization has never stuck, in the industry.
Okay. You mentioned a very interesting scenario where price of 3,300 rupees today for a airline flight from, let's say, Mumbai to Chennai, the price might change from 3,300 to 4,400 next day based upon whether a revenue management system has run during this period and how the inventory allocated has got consumed. Now, linked to this, I have one question. See, based
Sure.
upon the actual consumption of inventory, the allocation of subsequent allocation of inventory in subsequent phases can also add inventory to lower fare slabs. Okay, so as a result, it might shouldn't it happen that in certain cases where not sufficient demand is showing up, the airlines also reduce the prices, because oftentimes what happens is uh, when we are traveling in flights, we see there are so many seats empty, and we also see that the price charged over the last few days of the booking, the prices were exorbitantly high. So the airline chose to fly with empty seats but did not choose to drop the prices and fill up the seats. Why airlines are not moving prices in both the directions?
Yeah, it's a good question. For a couple of different reasons. One is, all revenue management professionals are taught to that airline yields have to be a monotonically increasing function. Meaning the revenue on for any given flight, the revenue per passenger that you garner today has to be higher than the revenue per passenger that you garnered yesterday. Okay, and the right revenue management always follows a monotonically increasing function. Otherwise, what you end up doing is, the scenario that you outlined, where you held back too many seats, believing that you're going to get demand at a higher level closer to departure. When the customers are willing to pay more, instead of graduating from a leisure passenger to a business passenger. Okay. Having said that, there are seats available part of the reasons the airlines do not, drop the prices, or rather drop the seats to the lower prices, is because of the chaos and the heartburn that creates in the marketplace. A few instances in my old company where we are for suddenly if the demand doesn't materialize closer to departure, you cannibalize the customers that are willing to pay higher, because essentially everybody pays a lower price. You're upsetting the marketplace where there were customers that paid a higher fare, okay, farther out, find out that there's a cheaper price selling now, okay, and because their customers come back to them and tell them that they feel cheated. These two reasons, the airlines, I'm not going to say that it never happens, but the airlines try very hard not to drop the price closer to departure.
So it's basically a trade-off between filling up seats versus customer satisfaction. Absolutely.
Exactly.
Now there are many startups uh, in the the taxi app industry that are following dynamic pricing, which in some sense has similarities with airline pricing. Any tips for those types of startups? Things they're doing well, things they're not doing well.
Well, the biggest tip, if that I could have, is is to make sure that the startups analyze the data, right? There's an incredible amount of revelations that comes out of the data. At the end of the day, airline revenue management is all about parsing the data, understanding the history, constructing the forecast based on the history, and then using those forecasts to determine whether or not to charge a certain fare on a certain flight or a certain itinerary. My sincere advice would be to invest in data collection, and more importantly, invest in data analytics, because data doesn't lie, and certainly large amounts of data don't lie. Able to but in the case of the car industry or the taxi industry, as long as we are able to segment by zone or by route or by a certain, call it a suburb, whatever the case may be, okay, and as long as we are able to capture enough data for a sufficient period of time and analyze the data, slicing and dicing it, and constructing analytics on top of the data, and obviously, to the extent that we have the luxury of experimenting, with different yield management techniques or pricing techniques, and do the analytics on the experimentation to improve upon it further, I think we're going to be in a good shape.
So, if I might summarize, basically do fact-based pricing, analyze the data, data doesn't lie, and do lots of experimentation before finalizing what your optimal model should be. Wonderful. Now, lots of analysts and lots of pricing experts have talked about personalized pricing in the airline industry space, where based upon individual customers history, that customer will be offered a different price vis-a-vis the other customers. What are your views on this? Is this something that airlines are heavily investing in? Is this an area that's going to be more and more prominent going forward?
Yeah, it's an area that is still very much nascent. We used to call it customer-centric revenue management. At the end of the day, we're saying the same thing, whether it's pricing or revenue management. We customize the fares, to a certain customer or a certain class of customers. This has never thought of, right? Airline is probably one of the industries or the most pay a bit more or quite a bit more, because of the nature of their flying habits. Having said that, really the customized pricing has taken the form of customized offerings. Okay, there are discounts, that are given, to a certain class of customers. For example, the airlines are getting better higher tier customers like a platinum customer or a gold customer with certain discounts. and even those are certainly primitive, which is quite surprising. And this is something that we are tackling ourselves. Even the hotel space, which lacks airline space, when it comes to air management, they are much better in terms of what we call database marketing or campaign management. And we do this for a very large hotel chain, and we construct campaigns, on a very customized basis. And we are looking at extending those opportunities in the airline space, which have been sorely lacking. Today, it's a lot of carpet bombing that happens, lots of similar fares, that are sent to pretty much the entire market, and there is very little to speak for that.
Now, you mentioned lots of corporate bombing happening in this space. I also see that the customer connection has shifted from directly connecting with airlines to connecting with the OTAs. And I believe that bulk of the bookings now happen through OTAs. Does that make demand forecasting even bigger challenge because you might not have a very good sense of lost demand because of pricing?
Well, strictly from a forecasting standpoint, Anshu, I don't think it makes it any easier or any tougher. At the end of the day, that demand still shows up as a, or the realized demand obviously shows up, and an unrealized demand, sure, one could capture the various website navigations and determine that a certain consumer went to a certain page and chose not to book or not to look for that matter. Okay, but again, there is very little that is done in terms of leveraging that information. So strictly from a demand forecasting standpoint, the fact that a consumer books on an OTA or through a travel agent, as opposed to booking on the airline website, has very little to do with the efficacy of the algorithm itself. Okay, so there are other benefits of booking on the airline website. As we all know, the Indian market is still quite nascent. When it comes to airline website bookings, I would say somewhere south of 20% is what is booked on airline websites. To a market like the US, it is almost 40 to 50% that is booked on the airline websites. Customers leverage the web bookings or the fact that the bookings are made on the website to improve the revenue management systems? Not really.
Okay. Now, I would like to take case in point being the Virgin Airlines. Now, when airlines are spending heavy on customer experience, are they able to monetize delivery of better experiences as well, or is this pretty much a commodity and customers don't care for the experience? What are your thoughts on this?
So customers want a lot of stuff, but the moment you ask them, are you willing to pay for it? The answer is almost always no, right? Having said that, um, there are, airlines worldwide have understood uh, are understanding the world of ancillary revenues, better and better and better. They are, getting better at striking the balance between offering customers or certain elements free versus charging for the other elements. You look at the US, for example, you have various shades of low cost carriers. Somebody like a Southwest US, but you may have other things. There are more mature low cost carriers have learned this art. In fact, in the US, even the full service carriers, pretty much charge for most items, including an enormous amount of revenue that they gain from excess baggage or just baggage. I don't even want to call it excess baggage. So at the end of the day, it comes down to the maturity of the industry and the choices that the customers have to make, or the choices that the customers can make. And if the industry moves forward, and if the industry is able to identify what is monetizable and what is not monetizable, and if the regulations permit them to do so. And that has been the challenge in India, for a lot of years. Then I think the airlines are in a good place. For products the consumers don't like it, and for the longest period of time, in fact, even today, Southwest in the U.S. does not charge for bags, and it's the only carrier that does not charge for bags. Whereas carriers like United, Delta, they get billions of dollars in additional revenue by charging for bags, check-in bags. I mean, okay. And the jury is still out, and the prevailing wisdom in the U.S. is Southwest is absolutely being irresponsible to its shareholders in not charging for the bags, and the fact that they don't charge for the bags doesn't bring any more customers when you compare the Southwest load factor to the rest of the industry. Shows that it is a differentiator, and they're sticking to the principle. If you offer a product that and you don't charge for it, and the rest of the competition is charging for it, are the customers coming to you, because you don't charge for it, or would you rather monetize it?
Okay. We have many fantastic questions posted by the audience. I'm going to take questions from Twitter, questions posted by audience now. First question is from Mrunmay Matre, and she would like to know, how is Indian airline industry different from American?
Lot of differences. that this I can speak for hours on this. Uh, it is there are several differences. One is the fact that geographically the Indian market is much smaller than the US. It's one-sixth of the size of the US. The Indian marketplace, does, at least for the short haul flying, it does offer train as an option, whereas US, given that the public transportation system is non-existent, other modes of transport are not an option. So that is point number one. Two, there has been rampant consolidation in the US industry, and that has led to an incredible amount of discipline, in the capacity that is being offered to the consumers, much to the consumers' chagrin. This has clearly resulted in a skyrocketing of the fares, and coupled with the low fuel prices, US carriers are laughing all the way to the bank. The Indian industry, in contrast, is still a sunrise industry. It is a growing market. Of late, the market is growing at the rate of 20%, year on year. And you got to remember that growth is coming on the back of very cheap fares. It is partly driven by affordability and partly driven by the urge of the airlines to fill the seats. And there is rampant capacity increase, in the industry in India, and capacity continues to outstrip demand. And when you do that, you're always trying to fill the last seat in the plane, and you fill the last seat in the plane by offering a lower fare. And this has led to a perennial sort of a depressed scenario for the cost environment doesn't help. US domestic fuel prices are up to 60% more expensive when compared to the rest of the world. And fuel comprises about 40% of the overall cost, for any airline. And when 40% of your cost base is 60% more expensive, you're leaving the airline with very little opportunity to make money. And from a airport standpoint, you don't have secondary airports. So in the US, for example, it's all well carved out. The large carriers operate in the primary airports. The smaller carriers operate in the secondary airports. And they're able to pass along some of the cost advantage to the consumers. Pretty much every not pretty much, but every city has only one airport, and the second airport has still been a pipe dream. Given the population constraints, and so there are just way too many differences, between the Indian and American marketplace. There are differences between the American and the European marketplace. So each market is its own animal, and with the lots of pluses and minuses.
Great. Well, thank you. Another question is posted by Sanket Majumdar, and he would like to know, instead of selling seats, why don't airlines sell miles? Okay, I think what he is referring to is, and I do remember one article sometime back where one University of Chicago professor had also said something similar, that airlines should look at offering an annual package of flying miles, and customers can choose which flights when they want to fly. Why aren't airlines doing that?
So today, actually, the airlines are selling miles, except that it's not terribly popular. You know, if you go to the Jet Airways site, for example, you can buy miles, right? And you can top up your your existing quantum of frequent flyer miles with the miles that you purchase, and then you can use it, for for a trip, for example. Now, if the question is why can't it be the only currency, I don't think that is practiced anywhere in the world, uh, for a number of different reasons. One, a, it's not practical. These miles are also sold to the partners. Okay, so when miles are sold to the partners, there is a certain value that is attached to the miles. Okay, and the same value when applied to an air ticket, and if the airline were to sell the miles the equivalent to what they want to offer for an air ticket, there's going to be a wide disparity in the value. So it is in the airline's interest to make miles the predominant currency, because it is able to achieve a disproportionate amount of value by selling the miles to its partners. If that makes sense.
Yeah, sure. Now, Shreyasi would like to know any advice for someone who's looking for a career in airline revenue management. Wow, you have spent more than 23 years, so you will have the best answer for this.
Yeah, I would. You know, I'm only being half funny here, but if you like suffering, join the airline. It's a, let me say this. It's an incredibly rewarding area. I mean, any airline job is an incredibly rewarding job from a job satisfaction standpoint. It's not for the faint-hearted. It is you know, airline industry, especially in India, is a very very rough industry. Okay, and there are just a humongous amount of constraints, both internal and external. And there are a couple of private carriers that practice revenue management well in India, including my old company. But for the most part, it is just a price game, that happens here. Few people that just monitor each other's prices, and they move their own prices up and down without a lot of science behind revenue management per se.
So essentially, it's not just revenue management, but it's also important to decide which airline you should look at pursuing your career in. Great. Uh,
Absolutely.
D. Sunit would like to know, according to you, which airline has best pricing strategy?
Well, if it is worldwide, I would say the U.S. carriers do quite okay.
Okay.
Yeah, yeah.
Anyone in India, I'm sure you're going to pick your previous employer.
Well, that'll be the natural bias.
Yes.
I wouldn't call out. I think between Jet and Indigo, they do well. In terms of understanding the marketplace and reacting to it appropriately. The Gulf carriers are getting better and better. They have an incredible array of markets that they need to worry about, and it's all about connecting traffic for them. It's all about flowing traffic between worldwide O's and D's. Emirates does quite well from a pricing standpoint. I would say the Gulf carriers, the large network carriers in both in Europe and US, they all have again within the constraints of the system, they all have this quite nailed.
Great. Next question is from Techno Geek Talk, and he would like to know, why hasn't there been a drop in flight prices, considering that the crude oil prices have dropped considerably, I would say.
Well, that statement is not true in India. Okay, so the fares on an average are down anywhere from 15 to 35% year on year. We all think that we are still paying a higher price, but you look at, I in fact, my I spent years watching fares, and even though I'm out of the industry now, I automatically go and just for the heck of it check some fares. I was checking a fare from Mumbai to Delhi just last week, and there are fares out there for 4,500 and 5,000 rupee. Last year, it was in the 10,000 rupee range. So the fares have certainly dropped. I would say, in some cases, more than the drop in the fuel prices themselves. However, what you're saying is true in the US marketplace. The capacity rationalization, the carriers have not followed through with a fare reduction, even though the crude prices have dropped, quite simply because they didn't have to. There's a paucity of seats. The customers have no choice but to pay a higher price, and for that reason, the U.S. carriers are are making profitability of historical proportions.
Yep. Uh, well, I was thinking you might say crude oil price is not a factor, it's not an input factor in the revenue management or the pricing algorithm. All right.
Well, well,
Not directly. I mean, I'm just picking on this.
no, it's certainly not. However, at the end of the day, we are all subject to market forces. And
Yes.
again, it goes back to the need to fill the seat, the need to fill the last seat. And the last seat comes, because of inducing demand by dropping the price. We are forced to do it, like in India. Whereas in the US, the need to fill the last seat, you know, because of come off the market.
Yeah. Yeah. And in some sense, being a pricing person, I really like when someone doesn't price purely based on cost. So if they're ignoring if they're not directly factoring in the crude oil prices, I think that's the way to go, anyways. Rahul Poti would like to know why Priceline, name your own price model, wasn't introduced in India.
Okay.
So
Well,
will there be a potential for a Priceline type name your own price model in India? Is that an empty space
yeah, there
available?
were no, there were a couple of companies that dabbled on this. Okay, and not to a great degree of success. And this is I'm saying this from about 5 6 years ago. Okay, at the end of the day, for these models to work, there has to be some kind of how do I say this? Some kind of a recognition across the industry, to accept such a model. Okay, and given that, and again, I go back to the maturity in the industry, right? So given that the U.S. industry is mature, carriers don't discuss prices. There's a critical mass of carriers that come together, not come together, but adopt a certain mechanism like Priceline. Okay. Whereas in India, given that carriers are at different levels of maturity, and they're all, there's a lot of irrational competition that exists in India, much more so than the US and perhaps Europe as well. Okay, there has been an inability to bring the industry together on a concept such as Priceline. I think that's quite simply the reason. Could Priceline work in India? Why not, right? It could work in India, but for it to work in India, to come together on the Priceline platform, and that has not happened yet.
Great. Rohan Shrivastava would like to know, even if the customer doesn't show up, he still pays for it. How is seat a perishable commodity in this case?
Well, yes and no. Okay, a customer that may have paid a lower fare, still pays for the seat. The customer, well, two things. Whereas a customer that pays a higher fare, like a full fare customer, still has the ability to no show and collect most of his fare back. That is part number one. And part number two, no show. Customers have the ability to cancel up to 2 hours before departure and only pay a small cancellation fee. So at the end of the day, if you made a booking, say 6 months from departure, and you canceled one day from departure, the ability of the airline to is dramatically diminished. So it is not just a no-show that we are talking about. We're also talking about last-minute cancellations.
Yeah, absolutely. Because the seat, when it becomes available so late, airline will really have difficulty filling that up. So you basically end up paying a penalty for deciding to cancel so late. Great. One final question I would like to ask you, which is, what roadmap should companies follow when they are setting up price optimization technology platforms in their organizations? You have many years of experience in implementing and researching optimization platforms. So, would like to hear your views on this.
When you say roadmap, Anshu, you're talking from an organization standpoint or from a technology standpoint?
Organization standpoint.
Standpoint. Okay. So I would say it all starts with with the human with the human capital. Okay. And it is incredibly important to have smart people that have the ability to understand the market, that are numerically inclined, and that are not afraid to experiment. Okay. And maybe this is asking for too much, but successful pricing departments need smart people that are highly quantitative and that are willing to persevere through experimentation and the outputs or the outcomes coming out of the experimentation. Then how the problem is resolved. Now comes giving them the weapons to be able to do these things, and that's what a good a good data source, a good database, and a good set of analytical tools help them in their analytical activities. So if you have the right if you have the right resources that are in tune with the market, that are willing to experiment, continually evaluate the cause and the effect, and you support them with the right set of tools and the right set of data, I think we're in good shape.
So basically, companies should first set up a team of analytics geeks, make sure they do lots of experimentation, they are given the freedom to experiment with new stuff, and then the next piece would be to give them the right tools so that they can deliver on the new expectations.